Life and Money Show with your host, Mary Jo Cesar, the live show and podcast dedicated to helping professional women achieve financial wellness by merging the emotional and practical sides of money. I am your host, as I mentioned, Mary Jo Cesar, and I am thrilled to bring you an extraordinary seasoned professional, a master of the real estate investing universe, Kevin Amolsch. Okay, Kevin, I hope I said your name right.
You got it, MJ. Great job.
Is one of exceptional resolve and impressive achievements. He's not just a successful real estate investor and private money lender, but also a decorated U.S. Army veteran, serving for 4 years before pursuing and earning his finance degree. Thanks for your service, Kevin. But Kevin's learning did not stop at the classroom. He delved into the fast-paced world of Wall Street, honing his skill as a mortgage bond analyst for 2 years before he heard the call of real estate investing full-time. With a record of over 2,200 transactions as a buyer, seller, or private money lender, Kevin's expertise is undoubted. At present, he manages multiple mortgage funds amounting to an impressive figure of over $750 million in closed loans. His track record speaks volumes of his 2 decades in real estate investing and 16 years in real estate lending. As an author of the noteworthy book, 45-Day Investor, Kevin shares his insights and experiences to guide budding investors on their journey. He is also a well-respected figure in the industry, regularly speaking at events, and quoted in high-profile publications such as the Las Vegas Review-Journal, the Denver Post, Yahoo Real Estate, Denver Business Journal, Forbes, and many others. So in today's episode, titled Passive Real Estate Investing, we'll dive deep into Kevin's vast knowledge pool and unravel how passive investments in real estate can reap substantial benefits. So get ready for an enlightening discussion, rich with insights and first-hand experiences that will undoubtedly help you better navigate your own financial journey in the realm of real estate. As I mentioned, Kevin's journey is a testament to his relentless pursuit of excellence and a desire to create wealth through smart investing. Now it's time to explore the depth of his wisdom and gain some priceless insight. So this is the opportunity, listeners, to learn from one of the industry's most respected figures, Kevin Amolsch. Only on this episode of the Merging Life and Money Show with Mary Jo Cesar. So sit back, relax, grab a pen and notebook, and get ready to take some notes. Our conversation today will revolve around 3 points: passive real estate investing, creative real estate financing, and real estate lending fund. So our first topic is one that is intriguing to many, but understood by few: passive real estate investing. Kevin, let's dive right into this. Can you explain what passive real estate investing is and why it's a good strategy for someone looking to invest in real estate?
Yes, I would be happy to, MJ. And I must say, that was the best introduction that I've ever received. So kudos to you. Thank you so much for having me on. I am super excited to start dropping some nuggets on your listeners. So you said grab a notepad and a pen, and I couldn't agree more. I'm going to do everything I can to add some value here. Your question to me was, what is passive investing? So when I'm on stage, let's say, and I'm in front of a room, and usually these are real estate investors because that's what I do. I might ask the room, okay, how many of you in here have a rental property in your portfolio? And I'll throw my hand in the air. And I would say 70, maybe 80% of the room, we see hands go flying in the air. And I say, fantastic. Leave those hands up if those rental properties are a passive investment for you. Without question, without exception, 100% of the time, all the hands come down. See, we think about real estate investing and building wealth, and real estate investing will do that. Absolutely. In fact, I think real estate investing and owning real assets, real properties, is the number one surest way to become rich, wealthy. But it's not passive. It's just not. It takes work. So you have to manage the tenants. You have to manage the construction. You have to manage the repairs. Even if you have a property manager, you have to manage the manager. So when I think of passive investing, MJ, I'm thinking of what investment can I be in where I could be on the beach, maybe in your hometown, drinking a frozen cocktail and not worrying about anything at all. That money just keeps on coming in. I don't have to go deposit a check. I don't have to answer my phone. I don't have to check on a tenant. I don't get any phone calls. That's passive investing. When we think of wealth, we think of being able to do what you want, when you want, with who you want. Passive income creates that.
Okay. I guess there's passive and passive, right? All depends how you.
So we could talk about some of the specific strategies on how to create a real estate investment that's passive. Would you like me to go into that?
And not necessarily, because usually, and the way that you framed it was great. It's not passive because you still have to manage it. You still have to maintain it.
Right. But there are ways to use real estate and invest passively. You just need to have somebody else do your work for you. It's leveraging. We talk about leverage all the time. We could leverage our dollar by getting a loan, but we could leverage our time by hiring somebody that has the time. We could leverage knowledge.
Totally. Yeah. In the realm of investment, right? When you say, okay, I use a passive investment approach as opposed to an active one, that's quite different from what passive mean in the realm of real estate investing. That's what I mean.
Yeah, no, and you're right.
Yeah.
And that's why I started when you asked me the question with a story about people in the crowd raising their hands, because so many people were taught that buy real estate because you'll get rental income and it'll be passive for you. But you've had some rental properties. It's a great investment.
It's always great when you go and check to see if your real estate manager is doing their job. And at the first of each month, you go and check your account balance. Oh, yeah, it's here. That's a great feeling, right?
Right.
So I'm with you there. I have a second question for you. What are some of the key things to look for when pursuing a passive real estate investing strategy?
Yeah, so let's get into that, because when I say you have to leverage someone's time to become passive, that's absolutely true. So now we're talking about relying on somebody else. Now we got to make sure that we're dealing with the right people. So there's two types of truly passive real estate investments, and there's debt and there's equity. So on the equity side, it might be, I'm going to invest in a project that somebody else is managing for me. So let's say we have 3 people that all come together to buy one. Let's just use a real simple example. One rental home, like a single family home that we're going to rent out to people that want to rent there for long term, like year or lease or longer. 3 people come together to buy that one property. If one of those people are designated as the manager, maybe they get a little extra fee, maybe they get a bigger piece of the pie, however we cut it up, to compensate them for their time for managing it. But that means don't call me for anything. You're the manager, you handle it. So that's what I would consider equity passive investment. So I physically own a piece of the real estate. That real estate deal, there's 3 of us, we each own 1/3, or however we chop that up. That means I'm participating in the ups and the downs. So if there's a down market and things aren't going so well, I might lose a little bit of money. I might not make as much as I was expecting. But in a typical environment or a good environment, then I would make more money because the property value is going up, the cash flow is going up, we're getting some tax benefits, all of those things that you would get if you own the property all by yourself. Now, the other passive investment is debt, which would be, okay, I'm going to make a loan to somebody that wants to buy that single family rental home. So now I don't own the property, right? I am the lender on the property. So I have a lien position to protect my asset, protect my investment. But now I really don't have to worry about any of the work because I don't own it. Every month I get my payment just like you would pay your mortgage on your home as a lender. So we're really talking about becoming a bank here. And the reason I like that, you're not going to get the big upside. If it's a great market and the house goes up in value, you don't get any of that benefit, right? The owners of the home get that benefit.
Mm-hmm.
But the debt investment is really passive and it's very safe because who gets paid first if there's a problem? It's always the lien holders.
Yep.
So you potentially might be giving up a little bit of your return, but then you could really be on the beach drinking that cocktail and not have too much to worry about, right?
Particularly when there's market fluctuations. You don't want to have to be wondering, as you said, you'll be sipping your cocktail on the beach, hassle-free.
Yeah, and for us, we're really safe. So when we do a lot of this. So when we make a loan to somebody, we might be at 65 or maybe 70% of that value, the property's value. That way, if there is a market shift or there is a default and it takes us a little while to repossess the property, we have enough spread, we have enough equity, enough room to recapture all of our investment. That's why I'm saying that it really is one of the safest investments you can make, especially in the real estate world.
Correct. Yeah. Great. Thanks for that. So how can a beginner get started in passive real estate investing? And what are some of the common pitfalls they should avoid?
Yeah, so it depends on what side you're looking at. If you want to get into the equity side because you like the potential of a higher return, those are a little bit harder to find because a lot of those types of investments are reserved for accredited investors only, and they're all private. So they're not allowed to advertise for it. So you won't be driving down the street and see a billboard that says invest in my apartment complex or whatever. You really have to get into the networks and know someone who knows someone kind of thing. So the way you would find those, there is some of that you could find online, and there's some crowdfunding sources. So maybe the listener, if you want to just write down crowdfunding and Google that, you'll see some sites that give you some of these opportunities. But it's really networking. So if you are interested in this type of investment, I would go to where those investors are. So the real estate investment clubs, the conferences, the meetup groups. Meetup is one of my best friends, meetup.com, because you really can meet a lot of people that are like-minded and can help you through your career. So those are all great places to find, great places to find the equity investment. The debt investment is very similar, except for it's a little bit more regulated. So you could find some of this stuff online and through advertisements and that kind of thing, because there's a lot of operators out there with mortgage funds. Right. So for us, for example, we have a public mortgage fund. So we would put advertising out there. Hey, we're giving an 8% return in this debt fund. So we're getting accredited and non-accredited investors investing in that, just simply because we went through the process with the Securities and Exchange Commission to get approved to offer that publicly. But that too, the debt side, you could also find those at your networking groups. Let's say you want to loan, you don't want to be a part of a pool. You don't want to be a part of any other investments. You've heard about the Ponzi schemes and the Madoffs and all of those things. So you want to be very safe. Mm-hmm. If that's the case, and you might want to make an individual loan to an investor and make sure that your name's on that mortgage, your name's on that deed of trust, that gets recorded with the county. So it's public record. And that way it's super transparent and there's no concern with someone running off with the investment. But to do that, you need to find the borrower, of course. And so again, you would find those at your investment clubs, or there's some online forums and online stuff. Bigger Pockets is a fantastic resource for this kind of thing. Biggerpockets.com.
Yeah, that's great, because that's not something that you could just walk in and say, okay, I want to do some passive real estate investment. It doesn't work quite like that. So that's why I asked the question specifically, because it is something that, anybody who's looking at diversifying their investment portfolio would be quite interesting in finding out. So that's good. Now that you explained that stuff, what are some success stories you've experienced?
I love this. I love this question. And I haven't really gotten this one very much in the podcast that I've been doing. I get notes and letters pretty regularly from investors that just thanking them for changing their life. So the success stories is I was able to retire 3 years earlier than I was expecting because I have this income I can count on. And I started getting these testimonials like on the phone or an email. And so I put together a little testimonial video like any entrepreneur would, right? And it's just so touching to hear what the stories of some of our clients and what they've been able to do because they know that they have something that they can count on. But on the flip side, we take the money in and we loan it out to investors that fix and flip houses. Gosh, we're changing lives on that side of the business too. To give you an example, I had I can't remember what his name was right now. I know his last name started with an E, but I can't remember what his name was. But he came to one of our events, learned how to do this deal, borrowed money from us. And he went from owning no properties to almost 20. And he totally quit his job, became a full-time real estate investor. He's a multimillionaire now. So those are the types of stories that I just love. I love getting those through email and phone calls and even better handwritten notes. You don't get those too often anymore, but every once in a while, one of those will come in.
Yeah, well, that's great. And as I said, that's not one of the main types of investment that you could find in any street corner. So that's why it's very important to educate people and educate the audience about it. So how do you balance risk and return when it comes to passive real estate investing? Because I heard that the great stories to any good investment, there is a risk reward type of situation.
Let's talk about the passive side and the debt side here, because I think that's the safest. So it's an 8% return, which isn't nearly as attractive now as it was maybe 12 months ago, because now you can get a CD, which is so bizarre. It seems like the shorter term, the CD, the more interest, which has never been like that. So you can get a 9-month CD, let's say. I just got one with USAA for 4.9%.
Yeah, 4 plus, yeah. Mm-hmm.
So now our 8% fund isn't nearly as attractive, right? But it is still better than a CD, and it is backed by real estate in this country, where we're located, so we could go out and touch it. And we're seeing a flight to quality right now with the instability of banking and the instability of the stock market. I don't think many people would sit here and tell you they have confidence the stock market is going to be higher at the end of the year than it is right now. There's just too much uncertainty out there. And if you look at going into a recession, which most people agree we are, interest rates always go down during that type of environment, always, 100% of the time. They have to loosen the economy. So when interest rates go down, stock prices go down. You can look through history and see that. So I think that there's some real risk in the stock market. Now, I'm not saying take your money out of the stock market. That is not what I'm saying. I do think you should be diversified. And MJ, I'm sure you agree with me on that.
Yeah, totally.
I'm just saying some money might need to go into Main Street. So some Wall Street, some Main Street. And real estate's a fantastic option because it's an inflation hedge and it produces income.
Yeah, I'm with you there. And I don't know why, but it seemed that for the past probably year and a half, maybe 2, there have been so much movement. I won't even call it fluctuation. So many school of thoughts about the whole recession situation, inflation, and and if you are not, if you don't have an interest of educating yourself on the whole investment thing, okay, and particularly I'm saying real estate because in the past 2 years we went from maybe 2% mortgage rate to what is it now?
Almost 7. I think it was like 6.8 the last I saw.
Those basis points, they add up at the end of the day. So that's why I don't even talk about the R word recession, because it's almost like the boogeyman. And it seems that it's being used to, I don't know if it's used to caution people or to scare people. Half of the population, more than half, don't even know what that means.
You know what? I don't know what a recession means anymore. I have a degree in finance, okay? And it used to be 2 quarters of negative GDP. Yeah. We've already had that.
Many times over.
And they're not saying it's a recession, right? Now it's, well, we got to consider unemployment. Yeah. Okay, so fine. Now, what does that matrix have to hit to be considered? Because it was high. It hit a 50-year low last month, but you just start adding matrix into your formula, but you don't tell us what those are. So we don't even know. No one can tell you what an actual recession is.
Yeah, I think everything shifted, and I can't even tell you if it's left or right. That's my opinion. Since the mortgage crisis, okay, all the textbook had to be either rewritten or burnt and start all over again, because it's that, and you had the advent of day trading. It's so many things that are affecting the way people view, spell, understand, and comprehend investing. And this is from traditional investing to real estate investing to whatever it is investing. So buyer beware, okay? Always do your research, talk to the specialists, talk to the professionals, the people that are in the know and the people that are following that stuff, because these are trendy now. So you can't operate with a mind of last century and wanted to have those kind of results today. This is basically impossible. You have the advent of cryptocurrency. I mean, everything mixed up that will really affect what investing means nowadays. Anyway, let's shift gears a little bit to creative real estate financing. So could you delve into what creative real estate financing means and how it differs from the traditional financial methods?
Yeah, for sure. So creative financing in real estate could be anything that's non-conventional. So you think about your 20% down payment, go get a 30-year loan, and you pay it off over 30 years. That's very conventional. Now, that's how most of us get started in investing in real estate, because that's what everyone knows and understands is go to the bank and get the money. Creative could be anything that's not that. So when I got started in this industry, I was going to college and I had a part-time job in the evenings, full-time college, 30-hour a week job. And I was absolutely in love with real estate investing. So I wanted to do that. I started all my free time, spent very little time with friends, which some part of me regrets, but I was highly focused on becoming successful. So I was making phone calls to motivated sellers. Like I would get lists of people who are selling their home that might be going into foreclosure, all the landlords in my market. I had lists and I would just call them as I walked from one class to another class on campus. And what I was trying to do here is gauge motivation, see how badly they needed or wanted to sell their home. And if I felt that there was an opportunity to help them with their situation and acquire a property and make a profit, then I would schedule a meeting for the weekend. So I didn't have school on Fridays, and then I had the weekend, of course, off. So I would go meet with these sellers, and that's how I spent my weekends trying to negotiate deals. Now, when you have a seller in front of you, an individual person that has a problem that you can help them with, you can negotiate whatever you want, whatever you both agree to or what works for both of you. So to give you an example, when I was doing this a lot and I was broke and didn't have much credit because I was young, I would lease a property from a seller, making sure that we promised to make their mortgage payment for them. And we would lock in a purchase price, and then I would buy the house 4, 5, 6 years down the road when the value of the house went up. So we would call this a lease option, a lease with the right to buy the house at some point in the future. Right. And as the property went up in value, my option contract, that piece of paper, became more and more valuable. So I could just sell that contract to somebody, or I could actually buy the house, resell it. There's lots of ways to make money when your contract to buy something is much lower than the actual value. So I was doing a lot of those. Super creative. I didn't go to a bank. I didn't call the banker. I didn't put together an application. I didn't show my credit scores to anybody. And that's how I got off the ground and into the real estate game as a career.
Yeah, you must have read my mind, because my next question to you was, can you share an example of a deal where you actually use creative financing and how it benefited both parties involved? So you preempted that question. It's nice to know, because these are not the thing that the bank tells you, because it's not working in their favor. It will not be working in their favor. And that's why I like the podcast and those kind of things, where podcasters, knowledgeable podcasters, people like you, can actually bring value to the audience so that they understand that there are other things than the traditional way of transacting when it comes to any kind of investment, period. Okay, what are some creative financing strategies that have worked particularly well in today's real estate market?
I think we're going to talk about the mortgage fund next. I think that you said that was your topic. So that is another one, though. We provide the money to buy houses and commercial projects that need rehab. So we do only value add lending. So this is stuff that banks won't touch. And the reason for that is because these properties, in most cases, are not habitable on the residential side. And we can talk about the definition of that. or they're just not stable on the commercial side. So let's go through a stable apartment building, for example. A lot of banks are going to have a pretty high threshold for number of tenants occupying the building before they will want to lend on it. So let's say it's 90, 91, 92% occupied, or it doesn't qualify for a bank loan. But we know that with some remodel, some rehab in the units, and maybe adjusting the rent prices, usually it's down a little bit, we could attract good quality tenants and fill that property up and make it bankable. So in order for that project to be successful, we need to bring in some private money or some cash to buy it, remodel the units, get it stable, and then it's bankable. At that point, we could refinance it and pay off the private lender or the partners or whoever it is. So that's one, not as, but still a creative financing strategy to reposition an asset. Now on the residential side, habitability is a real thing. If you go to buy a piece of property as a rental, let's say a single family home, and that appraiser for your lender checks the box that says it's not habitable, and it could be something as silly as not having a conforming bedroom, which would require, let's say, a closet in the bedroom and a heat source, for example. If it doesn't have something like that, it's going to be non-conforming. And even though you could live there and it's totally safe, it wouldn't qualify for a bank loan. So some type of financing to come in, get that property where it's going to be bankable, put the closet in, run a heat line, whatever it is to make that bedroom habitable or conforming, then the property's habitable, and then you could finance it. So we do a lot of financing like that. But I've seen times where the owner or the buyer of the property will let the owner carry the loan for them just so that they can get the property into a bankable position, and then they go get their bank loan. So let's say I do an option contract on a property. I have 6 months to buy it. It has to be bought at this set price. I have 6 months. Now I got to get that property into a position where it's habitable. And the owners a lot of times will be on board with that. So that's a way to get in without using private money or partners or cash. A little riskier because you're not on title, but I'm just going off here, MJ, on tangents about different ideas that are in my head as we're going. But the universe is like anything you want, as long as you can create your mind, you can do it. Real estate creates that.
Yeah, that's good to know, because for most, it's probably their largest investment ever. And they want to be very cautious. And of course, they are not necessarily knowledgeable in the various flavors of real estate investment that are out here. So it is important. And so tell me, in your firm, do you educate people about those ways of financing any real estate investment? Do you offer specific training courses so people can really understand? You don't necessarily have to do things in a traditional fashion always.
Yeah, so to some degree, our company generates income from making loans to real estate investors. We bring in private money, we loan it out. That's how we make money. We're not realtors, we're not transacting houses, we're not consultants, we're not educators per se. We don't charge for it anyway. We do a lot of education, but it's all free. So to answer your question, we have the YouTube channel. It's youtube.com/Pine Financial. Tons of information on there about that, experiences that I've had in negotiating with sellers, that kind of thing. We do this, right? We do a lot of podcast guesting and get invited on different shows sometimes, or I think on yours, we reached out to you. But we do a lot of that to try to help people. I wrote the book that you mentioned. I think you mentioned the 45-day investor
45,
book. Yeah. Okay. So that was my story. So people would ask me all the time, how are you in college with no money buying houses? So I just wrote it down. This is how I do it.
This is it. We hear a lot about kids graduating with a mortgage around their neck with no house. That's called a student loan.
Yeah, exactly.
But you don't hear about the real mortgage and the real, that you could actually have access to right out of the college. So that's the reason why it is so important for people to understand that and to know that. It's the same way when you started about college financing. It's a lot of things that are available there and that are not necessarily readily in the face. And so unless you know about it, unless you do your research, or you wouldn't know that. And then you end up with a situation after in your early to mid-20s where this is it. It's going to be hard for the rest of your life.
Unless the
unfortunately.
government
So,
just gives you some free money, there's always that option.
yeah. So moving on to real estate lending funds. Could you explain what real estate lending funds are and why they are an attractive investment option?
Yeah, I mentioned this a little bit in the passive income, passive real estate investing section. But so a fund, let me back up when I started Pine Financial. So in 2008, I started the company and I had a small handful of private individual people that wanted to invest in individual notes. They wanted to invest in real estate on the debt side because of all the advantages we talked about: safety, security, steady, all of those things. So I would just align one private money investor with one real estate investor. I'd bring them together and I would charge some fees for that. And then passive investor would just loan the money to active investor and I would step out. That's how the company got started. Now, here was the feedback I was getting. We want more diversification. We want more liquidity because private notes, there's no secondary market for it. And we want a smaller investment amount. See, back then I might say I can get a $200,000 loan, but I need to go find an investor with $200,000 to put all in that one note. So my pool of investors, especially, were shrinking as values were going up. But I had a lot of investors that didn't have $200,000. They couldn't get involved. They were restricted, pushed out. So I took that feedback serious, started talking to other investors and attorneys, and ended up creating my first mortgage fund. So this is in 2009. And that solved all three of that feedback. Now what we do is we pool money from investors together into one entity. We use an LLC. And then we take that money from that company to make the loans to the real estate investors, the fix and flippers. Now the benefits of this: truly passive, diversified over a lot of different loans. So if one person stops paying, we still have income coming in and we could pay our investors. And then it's liquid. There's enough loans coming and going. Everything we do is short term. So if someone pays a loan back, it creates some liquidity and we're able to use that to pay investors back if they want their money back out of the fund. So I was really able to accomplish all three with just that very first mortgage fund. Now, I screwed that first one up, MJ. I'm not going to lie to you. I did not do that one, but you learn as you go, right?
Yeah, absolutely. Yeah.
So I created
right?
Exactly.
Yeah.
So I created a second one. I got a little bit better, created another one. I got a little bit better. And now what we have, I really think we've got it honed in. It's a public fund now, which is a much harder process to get approved. But now I could bring in money from non-accredited investors. So now it opens it up to everybody. And I'm really proud of that.
So would you say that it's highly regulated?
I think it's highly regulated. It sure feels that way. We have to report to the government twice a year. There's audited financials. They're looking into us. Plus, the state of Colorado knows exactly who we are. Look, when you're in this small of an industry and you're doing transactions, the regulators know who you are. And I, of course, have to be licensed and all that. So,
I mean, that's what you said, right? Trust and confidence.
Yeah. So exactly.
Yeah. So where do you see this heading in the future? The whole real estate lending funds?
I think it's going to blow up because of flight to quality. Look, there's turmoil out there. Like we talked about, people are moving their money out of banks because they don't trust the FDIC, which I disagree with, by the way. The FDIC doesn't have enough insurance to cover all the claims. There's no secret about that. They're about 1.23% of all insurable deposits. It's insane. But I don't think the government would ever allow the banking system to collapse like that. So I think your money is safe in the bank.
Do you really think that they ever anticipate that there would be a billionaire of every so many hours or second in a day?
But when you have SVB go down and you have all these uninsured deposits, we didn't know what was going to happen to that. Like, think of Roblox. You heard about how much money they had in SVB, right? It was a staggering number. Now, if the government didn't step in and protect those deposits, which according to what is written, they shouldn't have done, that would have created an absolute collapse in the market.
My God. Oh, yeah. This would have totally destabilized the whole financial foundation.
So they had to step in. So I think your money is safe there, but not everyone agrees with me. I'm getting a lot of feedback that they're just a little bit nervous about that.
Well, thank God there aren't tons of people with more than $250,000 in bank. But even with that, it's still very underinsured. So back to our topic here, given the size of the mortgage fund you are managing, what risk management strategy do you use?
Yeah, so we have very strict underwriting guidelines. And as we go through this uncertainty, we're meeting with the leadership team once a month to tighten those guidelines. And without exception, I think with maybe one exception, we've tightened guidelines on every meeting because we just want to get more and more safe. So higher credit score requirements, lower loan to values, more liquidity in the bank, higher profitability when we run the numbers on the transaction. All of these things help keep our clients safe, which in turn keeps us safe. With that said, we do have loss reserves and we have equity that's stacked on top. So we'd have to go through our loss reserves and our equity before it ever would hit our investors. And with all of that said, we're not required to take losses like banks are. We don't have to liquidate. We could hold those properties and just keep them and ride this out.
Yeah, that's called peace of mind, I could tell you. And you got to demonstrate it to your customers and potential customers as well, that your house is in good shape.
Yep. Basically. And that's all in the financials get audited, right? So you see all of that in the public records. So
public knowledge, totally. So before we wrap up, what lessons can our listeners learn from your experience in managing more than 750 million in closed loans?
Yeah, so I'm going to try to direct this at the listener here because I have a lot of real estate investor clients, and we talk a lot about what mistakes investors are making when they're on the active side because we have a lot of active investors as clients. Mm-hmm. And I think that this is probably going to be true to your listeners as well. But the words that we use, the questions that we ask, and the goals that we set when we're talking to our own self are way more powerful than most people ever give that credit for. Right. So if you're a high achiever, which you are, if you're listening to this, I would assume. If you're a high achiever, you have goals for yourself and you have dreams and you have these things that you're trying to accomplish. And when you set a goal and you're a high achiever, you do whatever you can to hit that goal. So your goal is way more important than you might even realize because you're going to hit it. So I would say be very careful with the goals that you're setting and make sure your goals serve you. What I mean by that is take ego out. You don't need to say, I have this much of something or this or that. And all of that feels good. And that might make you sleep a little better at night because you have people that respect you and look up to you and all of that. But does that really serve you? I guess that would be the question.
Yeah, totally. Great. Kevin, I'm sure that our audience has absolutely benefited greatly from your insight today. And I'm sure that many are interested in learning even more from you. I am. Could you share with our listeners how they can get in touch with you if they are interested in engaging your services or exploring your investment program or even just following your work? Before you start answering that, I have some information. So I'm going to run it at the bottom of the screen. So while you explain further, they would be able to see for themselves.
Okay. Yeah. And one thing that's not on here that I think is important, if you are interested in the passive debt investing, you could do that on your own. You don't need me or anybody else to help you, but be careful because there is some risk out there. So I get calls a lot from people that say, hey, I just made a mistake. Can you help me? A lot of the times those mistakes I can't unwind. So I can't help you. I wish we would have worked together, then we wouldn't have made this mistake. But that happens so often that I wrote a report to try to help people avoid those types of errors and mistakes if they're out there doing this on their own. So I wrote that report and another one I put on the website, just comparing the crash that we might be hitting to what we saw in 1990, because there's a lot of comparisons to that, very few comparisons to 2008, which most people compare it to. So those two reports totally free at thepinereport.com. That's thepinereport.com. Otherwise, it's all up on your screen here, MJ, but the best way to reach me is pinefinancialgroup.com.
Okay. And that information that you just mentioned, I will make sure to secure it and put it in the show notes when people, after they finish listening to the podcast. So folks, that brings us to the end of another enlightening episode of the Merging Life and Money Show. I will say that we had an incredible journey delving into the world of real estate with one of its leading experts, Kevin Amolsch. So from understanding the nuances of passive real estate investing, exploring the innovative world of creative real estate financing to getting a glimpse into the complex, I would say, yet rewarding realm of real estate lending funds, I think we covered some extensive ground today. Quickly, but certainly. So Kevin's unique insights and rich experiences have truly painted a vivid picture of the potential these areas hold for all of us. They serve as a reminder that the world of real estate is dynamic, okay, full of opportunities and accessible to anyone willing to learn and take calculated risks. So, Kevin, I want to extend my sincerest gratitude to you for sharing your valuable knowledge with us today. And for all our listeners, I hope that today's episode has inspired you. I got inspired, ignited you, and not just you, but your curiosity, and given you actionable insights to make informed decisions in your real estate journey. So before we wrap up, here are a few calls to action. So if Kevin's insight resonated with you, I encourage you to read his book, 45 Days Investor. I have not read it, but I'm sure that it is a wealth of knowledge that could well be the roadmap you need for your investment journey. So don't forget to follow Kevin on his social media channels. The information is scrolling under the screen there. And keep up with his latest insights and experience in real estate. Subscribe to the Merging Life and Money Show and never miss out on learning from experts like Kevin. So leave us a review if you enjoyed today's episode. Your feedback makes a big difference. And last but not least, share today's episode with someone you think might benefit from it. So let's grow our community of informed investors. And remember that investing in real estate does not have to be daunting or complicated. With the right knowledge, the right mindset, and a bit of guidance from experts like Kevin, it's an exciting journey that can truly merge life and money. So stay curious, stay informed, and keep investing. Thank you once again for tuning in, and I look forward to bringing you more insightful conversations covering a wide range of financial wellness topics in our upcoming episodes. I will see you next week, Thursday, at 7 p.m. Pacific Time, 8 p.m. Mountain Time, 9 p.m. Central Time, 10 p.m. Eastern Time, 11 p.m. Atlantic Time, and noon Friday, Brisbane, Australia time for my Australian friend. I am your host, Marie-Jo César. I will be back again next week. Until then, continue merging life and money. Bye for now.